Good afternoon, everyone. This is Katie Novotny calling in from Premier Marketing. As always, thank you so much for taking the time to join us today. Today, we are going to talk about something a little different than we have on the past few calls for Long-Term Care Awareness Month. We are so excited to have a new long-term care hybrid product being launched, and with a carrier that we don't usually work with on the LTC side. So this is going to be with Equitrust. Today, we have Jason Goodrich, who is our RVP with Equitrust, and he is going to run through the product, show the opportunities, and where they're really seeing it shine. So with that, Jason, you ready to take it away?
You bet, Katie. Thank you very much. Good afternoon, everybody. As Katie said, my name is Jason Goodrich, and I'm a Regional Vice President with Equitrust Life Insurance Company. Obviously, what we're here to talk about today is the brand new Equitrust product called Bridge, which is a very innovative and needs-based solution that I really do think is going to be a game changer when it comes to the asset-based long-term care space. Not only is this product going to be able to address the long-term care needs for your clients, but it's also going to help give them the best opportunity to avoid or at least delay long-term care altogether. On top of that, because of the very strong accumulation growth and the fixed index annuity chassis on the product, it's also going to help them to achieve their financial goals at the same time. So in a nutshell, it's going to address their long-term care needs, it's going to address their financial goals, and hopefully also address their health concerns all within one product. Now, before we get started, I do want to mention that the product is currently not available for sale, but it will be very soon. So the actual official launch date of the product, when you can start writing business, would be next Tuesday, November 15th, so just a few days away. Let me lastly just thank Katie and all the folks over at Premier. They've been a great partner with Equitrust since the very beginning of Equitrust. Appreciate all they do and their support and partnership with Equitrust. With that said, let's talk about Bridge. Okay, let me go through an agenda quick. Just what I'm going to talk about, just super quick, and then we'll get into the nuts and bolts of things. So first, I'll talk a little bit about where we're different, kind of where we shine compared to some of the other products in this space. Then obviously we'll spend a good amount of time getting into the product details, the long-term care rider, the underwriting, the wellness rider on this. And then I'll walk through a case scenario, which I think does a good job, really showing the value of the product. And then we'll close by just talking about some sales opportunities, that I see, some areas, especially with current clients, where I think this product could make a lot of sense in your business. Then lastly, I will at the end mention licensing and training because this is a long-term care rider. There are some licensing requirements depending on your state. Okay, why Bridge? Before I get into the product, I did want to briefly touch on some areas where we're going to be different than what is currently out there in the market now. Because of these advantages we've incorporated within the product, I think you'll see that this is going to be attractive to a much, much broader audience than the other products currently in this space. If you have clients that have the need for long-term care coverage, which I'm sure that you do, which is why you're on here, then they're probably going to be a great candidate for the Bridge product. I'll expand more on these as we go through the presentation, but here are just a few of the areas where we're different and I think much more competitive. Let me pull out my laser pointer here to help guide this. So first off, it's an FIA chassis. It's a fixed index annuity chassis. Because of that, you're going to see a lot of accumulation growth within this product. So in addition to the long-term care coverage, you're going to have account value growth. Number two, and a big advantage is flexible premiums. Talk more about this in a little bit, but you can add money to this product, which is a little different than what's out there. Number three, and once again, I'll expand on all these as we go through the presentation. But number three is the underwriting. It is a simplified underwriting process, which we'll talk about, but one of the very unique things is one of the underwriting classes is guaranteed issue. What that means is nobody will get declined. Everybody will be offered coverage. Next thing would be a custom long-term care benefit. The way we've designed this is to give the client some say in what coverage they want. We'll talk about that, but instead of us telling the client what their coverage is going to be, they're able to tell us, along with your advice, what would be the best option for them. The next thing is the claims process. This is an indemnity claims process. So no reimbursement, no receipts, very simple claim process. Another big advantage within our product is the charge structure, right? The way we do the charges to the client for the rider. We'll get more into that, but basically what you'll see competitively is our charges tend to be a lot lower than the competitors' charges in the product. And then we have a wellness rider, a wellness program that's part of this. We've partnered with a third party on that. That's hopefully going to give the client the tools they need to avoid the need for long-term care altogether. So it's a really cool program that we've added, on top of a really great product. Then the last thing I'd mention is this is a streamlined, completely digital process. I'll talk more about this towards the end, but it is completely digital, a very kind of slick process as far as the illustrations and the application. Okay, what is the objectives of Bridge and how can it help? Well, I mean, as you guys know, if you've dealt at all with asset-based long-term care products, most of them offer two very important things, right? One of them is long-term care coverage, right? Some sort of rider that addresses the need for long-term care. And the other one would be some ability to protect and grow assets. Now, the Bridge product is going to do both of these things. And I would submit it's going to do them in a much more flexible way, and I would say a more competitive way in a lot of areas. The third thing we're going to do, and the reason the name Bridge, is we're going to have a wellness rider on this, as I briefly mentioned, and we'll talk more about towards the end. So really, what Bridge is doing is it's bringing together the client's needs for long-term care, their financial goals, and their health concerns all within one solution. So let's get right in and talk a little bit about the product. Now, if anyone on the call has dealt with index annuities, this is very similar to one of our index annuities, our market value index, from a base product standpoint. One thing I will tell you is take away the long-term care rider completely, and this is a very, very competitive fixed index annuity by itself. So adding the long-term care rider to it just makes it even, a complete differentiator in the space. So the issue ages are 55 to 80. The minimum premium is $50,000. I do want to point out it's non-qualified only. Okay, so at least at this point, you will not be able to use this for qualified money. It is something we're looking at for down the road, but for now, it'll be non-qualified only. I mentioned it's flexible premium, right? So they can add money anytime in the first 5 years. So if any money in the first year they add, they're going to get that bump up in coverage ratio, right? That leverage on the additional premium they add in the first year as well, too. Then they can continue to add money years 2 through 5 and get a dollar for dollar benefit towards the long-term care. It's 10 years surrender charge and length, 10% free withdrawals, of course, like a typical index annuity. And as I've already mentioned, it has really strong accumulation value growth potential within the product. I'll show you the rates in a second, but like I said, just a very strong accumulation product. And then the commission very strong. So 8% street commission from 55 to 75, still 5.5 from 76 to 80. So much higher than what you would typically see on a 10-year fixed index annuity product as far as the commission. And in addition to that, we are running a commission special at launch, and it's running all the way until March 31st of next year. So any apps received from when we launch this product until the end of March will receive an additional 1% commission on top of that. So instead of the 8% commission, it's going to be 9%. Instead of the 5.5% commission, it's going to be 6.5% until the end of March. Okay, I mentioned really strong accumulation, and you can see here with the proposed rates, right? So these are the different index strategies we have and the caps and rates we intend to roll out with here next week. So you can see even the fixed account. The fixed account's at 5% right now. When I talk about the product being very competitive, even without the rider, you can see that here. 10% cap on the point-to-point strategy on the S&P 500. 40% par on the S&P, 65 on the monthly average. Then we have two volatility control indices with par rates of 150 and 175%, right? So just really strong accumulation within this product. I won't go into the illustrated rates, but you can see very, very strong illustrated rates based off of these current rates and caps. Okay, let's get right into the underwriting. So we have partnered with Assured Allies, who I'll talk more about in a little bit for the underwriting. So that's a third party that will be handling the underwriting for us. So there's 3 underwriting classes. Okay, there's secure, standard, and preferred. Secure is guaranteed issue. As I mentioned earlier, nobody will be declined for this product. Okay, so if they're uninsurable, they can still qualify for this product in the secure class. Okay, And the other thing is, I should mention too, is before I get into the underwriting, is they can opt out of underwriting. If they know they're going to be guaranteed issue, they can skip the underwriting completely and just take the guaranteed issue class and not even do any of the underwriting. Now, if they do decide to go through underwriting, there's 5 application questions on the application, just very short questions. There's no third-party involvement. So there's no APSs, there's no MIBs, there's no prescription checks in any cases, right? It's just going to be the 5 application questions, and then there is a live video assessment. Okay, that's going to take about 20-25 minutes or so, and so the client would do that via live video with an underwriter who would also be on video. Okay, so you as the advisor would probably want to be there with them, helping with the recording of this through your laptop or your iPad or something like that. Now, as all that's involved in that is, I think there's 10 things that the client has to do during that video assessment. 5 of them are cognitive, things like word recall, and then 5 of them are physical. And for example, one of the physical things they have to do is stand up from a sitting position in that chair, just to show they can stand up on their own and balance themselves on their own and sit back down. So it's, there's not a lot involved in it at all. Like I said, it's just 20 to 25 minutes or so. And once again, nobody's going to get declined, right? They're all going to be accepted. They're going to be offered one of these 3, preferred, standard, or secure. And I can tell you, it's not some sort of unicorn to get the preferred class. We expect about 70% of the people to qualify for preferred, right? So the majority of the people. Then the other 2 will probably about split between standard and secure. Now, you can see over here, there's a video. I'm not going to show it today, just due to time. But towards the end, I will give you our website and our MICROSITE, and there's lots of videos out there, including one on the underwriting. And this is a video you can actually show your client that helps them prepare for the underwriting, right? So tell them what to expect and kind of what the process is. So it's a really nice kind of video to help prepare the client for that. Okay, that's the underwriting. Let's talk a little bit about the rider. So if anybody on this call has ever dealt with income riders on annuities, this is going to work in a similar way. Okay, there's a benefit base, right? Just like there is on an income rider with an annuity, this has a benefit base, but it's for the long-term care rider. So based on the underwriting, right, the client's issue age and the underwriting class they get, we will give them an initial benefit base. And let me give you an example. So a 65-year-old that gets preferred, their coverage ratio would be 275%. So if they put $100,000 in, then their initial benefit base is going to be $275,000. Okay, so kind of, it's actually very simple, and that's their starting benefit base, and it's going to grow from there. And how it's going to grow is like an income rider. Again, it's going to roll up, and it's going to roll up on this product at 2% per year annually, compounded daily for 20 years or until they go on claim. So in my example, that $275,000 will go up by 2% every year until they go on claim. That's the built-in inflation protection for the product. Obviously, inflation plays into this. The cost of a nursing home today is not what the cost of a nursing home is going to be next year, right? That's going to go up. So this is going to have this built into it, so their benefit is going up every year, and it's guaranteed. They're going to know exactly what that benefit base is 5 years from now or 10 years from now, because that initial coverage is guaranteed, the 2% roll-up is guaranteed. So they're going to know exactly that number. Then the math is easy. Once they go on claim, is all you do is take that benefit base, right, and you divide it by 60 months. Okay, so this is the benefit base divided by 60 months. That will be their monthly long-term care payment for 5 years. And 5 years is the only option. Okay, and it's guaranteed to pay them for that 5 years, even if their account value goes to 0. The only exception to that math would be there is a 4-year vesting schedule based on the net amount of risk, right? The net amount of risk is the difference between the long-term care benefit base and the account value. So if they go on claim in the first 4 years, they would get a little bit less than that depending on what year it was. But 4 years in 1 day, it's going to be the full benefit base divided by 60 months. I will say the reason for the vesting schedule is because of the guaranteed issue option on this product because everybody will be accepted. Okay, and here's just kind of some sample coverage ratios just to give you an idea. So you look, let's go down here to preferred. So you look at preferred class, a 75-year-old, and this is gender neutral, so it doesn't matter if they're a male or female, but a 75-year-old would have 265% coverage, a 55-year-old 285% coverage, right? So it's just dependent on their age and their underwriting class. Where on the other end of it, a secure class, a 75-year-old would be 115%. So obviously there's a significant difference between the secure class coverage ratio and the preferred class, which is why it's going to be a big benefit for the client to go through the underwriting process unless they know they're going to be guaranteed issue. Now, I will say this 115% though is really strong leverage for a guaranteed issue product, right? For that client that's uninsurable and has $100,000, they're going to turn that $100,000 into $115,000 for their long-term care, and it's going to become tax-free, right? So there's a huge benefit even for an uninsurable to move into a product like this. Cost of the riders. So just like on all of our annuities, we have our nursing home waiver, we have our terminal illness rider. Those are no cost to the client, they're just automatically included. And then we'll come down to the long-term care rider that we just talked about. This is automatically included, and the way the charges work on it is first off, there's a premium load, and that's going to be 1% of all first-year premium. Okay, so if they put $100,000 in, there's going to be a $1,000 charge to them, so they start at $99,000. Then from that point, there's just going to be a monthly charge based on net amount of risk. So if you're familiar with life insurance and and how cost of insurance works, it's going to work similar to that. The difference is the net amount of risk on this product will be the difference between the long-term care benefit base and the account value. So the charge is just going to be on that amount. So for example, if a client's account value was $100,000 and their long-term care benefit base was $250,000, then the charge would be just on the $150,000 portion of it. And because this product has really strong accumulation value growth, what you see is you see that account value grow obviously much more rapidly than the benefit base grows. Because of that, your net amount of risk is getting less and less and less every year. And at some point in a lot of situations, especially the guaranteed issue cases, the account value is going to catch up to the benefit base. So at that point, there's actually no net amount of risk, which means there's no charges to the client, and it just becomes free long-term care insurance at that point. Okay, and that's another advantage of the really strong accumulation growth in it. So when you look at the way we're doing this charge, and when you get an opportunity to look at an illustration, what you'll see is competitively, at least against other asset-based long-term care annuities, our charges are much, much less, especially in the early years than the other ones, which because the charges are less, that additional money goes towards the account value growth and you get a lot more accumulation growth. And then we have the wellness rider, which I'll talk about in a second. That's just $100 per year, just a minimal charge to the client to use the wellness rider. Oh, I forgot to mention, I apologize, I forgot to mention, but with that coverage ratio that we give the client based on their age and underwriting, they do not have to take the maximum. So my example of a 65-year-old was their coverage ratio would be 275%, which it would be, but that you and the client can choose to take less. You can choose to take 200% or 100% instead of the full 275. The reason you might want to do that is by taking less coverage, you decrease your net amount of risk, which means you decrease your charges, right? And if you decrease your charges, you're going to get more account value growth. So you're able to design this product if you want to in a way to meet both needs of the client, the long-term care coverage need as well as the account value growth need. And this chart just kind of shows that. It just shows the more coverage you take, the less account value growth you get. So the blue represents the account value growth. Now, I will say this chart is based on guaranteed account value, which obviously is very unlikely to happen. I'm trying to get this updated to show non-guaranteed account values, like based off illustrations. If I had that, you would see these blue lines would be way higher. All three of them would be much higher than they are. And in most cases, the blue would eventually pass the long-term care benefit base, and that's where your free insurance comes in. So the point is, it's customizable, the benefit, right? The client can just take the maximum coverage, or they can take a lesser amount to help their account value grow. Really up to them. Now the claim, as far as the claim process, you do not need to be confined to a facility. It's just a doctor certification of unable to perform 2 of 6 ADLs or severe cognitive impairment. So that, along with a doctor plan of care, and they qualify to go on claim. As I mentioned, it's indemnity based, right? So it's not reimbursement, so there's no receipts. They do need to recertify annually, right? To keep receiving the payments every year, we do need recertification. They still can't perform 2 of the 6 ADLs. And as I mentioned briefly, this does meet the Pension Protection Act, right? So as long as it's used properly, these payments are going to come out to the client tax-free, right? Even the interest is going to come out tax-free as long as they're being used, for that long-term care need. So just kind of to summarize the long-term care rider, guaranteed issue, right? It's very important, but there's other options. There's preferred and standard as well too. It cannot lapse. Right. So once you turn on that and go on claim, it's going to pay out each month for 5 years, even if their account value goes to 0. Right. We're not going to stop that. We just mentioned the benefits are tax free. The flexible coverage, which we just talked about a little bit ago, giving the client the ability to choose the amount of coverage they want up to a maximum and to find that right balance of accumulation and long-term care. The 2% per year growth of the benefit base, which is the built-in inflation protector. And then the wellness program, which I'm going to talk about now, which is going to give them the opportunity to earn additional credits towards long-term care on top of what we already talked about. So let's talk a little bit about the wellness benefit. So we've partnered with a third-party long-term care company called Assured Allies to handle not only the wellness program for Bridge, but they're also handling the underwriting, as I mentioned a little bit ago. If you're not familiar with Assured Allies, they are a data technology and research company that was founded in 2018 to help long-term care carriers solve their in-force claim problems. So that's what they've been dealing with up to this date, is working with carriers' in-force business and trying to help their claims experience. And one of the ways they've done that was through their innovative wellness program, which really was designed to help clients age in place and hopefully avoid the need of ever going to a nursing home altogether. So what they've done is they've now taken that knowledge and they've ported it over to new products. And the EquiTrust Bridge product is the first new product of its kind that they've done this with. So combining the EquiTrust asset-based long-term care annuity along with the Assured Allies wellness rider. So what is the program design? Well, once the contract is issued, the client will work with an ally or a health coach at Assured Allies to build a customized action plan. Right? This is going to give them kind of a roadmap on some simple things they can do to improve their health, with the goal really being to age in place, right? To delay, reduce, or even completely avoid the need for long-term care services ever, right? They're just going to give them some simple things they can do from a health perspective to improve their health and to avoid needing the long-term care insurance down the road. By participating in this, what is the client going to get? Well, first off, they're going to get improved health, right? Which is important to seniors, right? To avoid that nursing home altogether. But by participating in the program, they can earn additional long-term care benefits. So up to 15% more towards their long-term care benefit base. So what we've talked about before this with the coverage ratio and the 2% growth, that's all guaranteed. They don't need to do the wellness program to get any of that. That's built into it. This is just something additional they can do that would help grow that benefit base by up to 15% more. Plus, they'll get access to discounts and all the wellness concierge and stuff to help them along. Now, if they decide they don't want to do it, they can terminate that rider. It comes at issue, but after that, they can terminate it if they decide they do not want to participate in the wellness program. And kind of real quick, kind of what the member journey looks like if they do follow the wellness program. And I should mention now that there is a website. Well, actually, our website, which I'll talk about in a little bit, has videos out there, including a video on this program. It's called the NeverStop program, which is the wellness program. So there's tons of material out there on it. There's videos on it. You can go to the NeverStop website too at neverstop.com. And there's videos out there on it and testimonials and things like that about the program. But really quickly, what's going to happen is once the policy is issued, the clients can go in and do a self-assessment, right? They're going to just do a self-health assessment. And once they do that, they're going to schedule a call with an ally or a health coach, okay? And based off of that call and based off that health assessment that they've done, they're going to talk about some customized or personalized recommendations, okay? It's important to know this is very personalized. This health coach is not going to tell the client, you need to do this or you need to do that. For example, if they decide, you know, one of the options is to exercise 2 hours a week, they're not going to tell their client, well, you need to go walk 2 hours a week. You need to ride a bike 2 hours a week. They're going to work with the client to come up with what's best for them, you know, and what fits what they like to do, right? The program only works if the client follows it, so it needs to be very personalized to each individual. And then based off those recommendations, the ally and the client will work together to build this aging map, right? And the client will hopefully make progress through that. Then every 2 years, we will credit additional credits towards that long-term care benefit base based on that. So every 2 years. And then we'll start over and do it another 2 years. And maybe it'll be the same plan, maybe it'll be a different plan. They just work with the ally to determine that. So in a nutshell, that's kind of how it works. But like I said, there's tons of more information on this on our website, which we'll talk about here in a second. Okay, let me go through a case example, which I think does a really good job kind of laying out the benefits of this product. We got David here, who's 65. He's got $250,000. He qualifies as preferred. As I said, we expect 70% to get preferred. So his coverage ratio is 275%, right? So the initial benefit base, you know, easy math, you just take the premium times the coverage ratio. So his starting number is $687,500. Now, David did participate in the wellness program, and the three things they identified for him were, you know, help with sleep health, addressing his hearing loss, and then stress reduction. Okay, so they gave him some different things he can do to address those three concerns, and David followed that. So let's go 10 years later. So 10 years down the road, the new benefit base. Now remember, the initial benefit base was $687,500. But because of the 2% growth every year, it's now grown up to $838,059 in 10 years. So it's grown quite a bit because of the inflation protection. This number is guaranteed, okay? That's all guaranteed. Now, David participated in the wellness program, so we're going to credit an additional almost $55,000 to that benefit base because of the wellness credits. Add the two together, you get almost $893,000 is his benefit base at claim, right, 10 years down the road. So divide that by 60, that's all you do to figure out the monthly benefit. His monthly benefit is $14,882, tax-free for 5 years to pay for that. Okay, so really a simple calculation. Now let's take a kind of a brief look at what an illustration would look like for David. Mainly what I want to point out, if you look over here, this is the LTC monthly benefit. So at year 10, you can see that was $14,882. But what's really interesting, and that's a really good monthly benefit, by the way, very, very strong. But I think what even separates us even more kind of from the industry and what's out there now is this. That's your accumulation value at the end of 10 years. So that accumulation value, which started at $250,000, is now $463,000 plus change based off the illustration, right? So if David never goes on claim, he still has a huge lump sum of accumulation value here he can use to supplement his retirement, you know, buy a retirement home, you know, do whatever he wants with, right? So the combination of these two make this product just very, very unique and very, very strong. Okay, let's talk a little bit about the MICROSITE I've mentioned a few times. So we do have a MICROSITE dedicated just to this product. It can be linked from our website. So if you're on our normal website at agents.equitrust.com, you can go right to the MICROSITE from there. Or you can see down here, here's the direct way you can go right to the MICROSITE for the product. If you go out there, that's where you're going to find all the information. Product training will be out there because product training is required, right, for this product. Tons of marketing material, lots of agent advisor pieces, tons of client pieces. As I mentioned, there's videos out there. Also, our state approvals are out there, and they're changing all the time. We're getting new approvals all the time. I will say right now we are at 23 state approvals. There's a calculator out there which is just gives you basic information. It's just an easy way. For example, if you have a 63-year-old client that's probably going to be standard, you can go put that in there and it'll tell you what the coverage ratio is going to be for that client, right? Just an easy calculation. These 3 things are all live on the MICROSITE right now. Now, the other 3 things are not live yet because the product's not live yet. So on November 15th, when we go live, that's when you'll be able to go out and run full illustrations, right? That's when you'll be able to do underwriting, and that's when you'll be able to actually write an application. So beginning next Tuesday. Now, I don't know if I mentioned this or not, but this is e-app required, right? So you cannot do paper apps with this. This is a completely digital process. I will say it's done through a wizard, so it works really slick. So once you answer a question in one spot, it's going to pre-fill that answer when it's asked again later, right? So you're not just retyping all the same information all the time, and the application process works very slick. So these 3 are all kind of tied together through that wizard. So I'd encourage you, if you have time, just to go out there and look around on the website. You don't have to have a login to get most of this information. Okay, let's kind of wrap up here by talking about a few of the sales opportunities I see with this product, and there's several others out there too. I think one of the big ones and the big opportunities out there is 1035 exchanges from both annuities or life insurance policies. There's a lot of people out there I know that have clients that have old annuities, right? Annuities that maybe are 12, 14, 15, 20 years old that have a lot of gain in them. Where the client doesn't really need that money, but they also don't have long-term care coverage. It makes a lot of sense to me, I think, to reposition that money via 1035 exchange into the bridge product. For example, if somebody has an old annuity that, let's say it's $200,000 and $100,000 of it's, it was their premium, and the other $100,000 was the interest, right? The gain over the last 15 years. Obviously, that interest is taxable when they take that money out or when they pass away. However, if they reposition it to bridge, that $200,000, first off, they're going to get that leverage, right? That $200,000 is going to be more than that based on their underwriting and their age. Then the next thing, just as important, is if they take that money out for long-term care, it's all tax-free, including that $100,000 of interest will come out tax-free to pay for their long-term care need. And if they're fortunate enough to never need the long-term care insurance, then it's just like an annuity, right? They still have the annuity. And they're still in the same situation they were in before they moved that money. So I think the repositioning of an annuity, another annuity to this product makes a lot of sense. Same thing with life insurance. I have an advisor I've worked with a long time who used to sell for a company he worked for, sold a whole bunch of whole life policies 25 years ago. And these clients were in their 40s at that point, and they needed life insurance, right? They had debt, they had kids at home, they needed an income replacement. Well, these clients are now in their 70s, and these clients still have these policies, but they don't really need the life insurance anymore. They don't have debt, right? They don't have kids at home. But also what they don't have is long-term care coverage or a plan for that. So, I talked to him, about talking to these clients about repositioning that life insurance, right? That's needs-based selling. Their needs have changed. It's no longer the need for life insurance, it's the need for long-term care insurance. And repositioning into a product like this for that reason. Of course, it's always a great option for the liquid money out there. Last I knew, there was over $21 trillion, sitting in places like money markets and checking, savings accounts, and CDs. Obviously a lot of that money the clients have sitting there, that's how they plan to pay for their long-term care, right? If they go in a nursing home, they're planning on just taking money out of that, that $400,000 they have sitting in their checking account to pay for that. Obviously, it makes a lot better sense to reposition that into a product like this and get the increase in leverage, but also get the tax-free benefits. Then to me, kind of the low-hanging fruit is the guaranteed issue. I'm sure most of you on this call have clients that are uninsurable, right? They can't really qualify for much. Well, they can qualify for bridge, right? And it's talking to me, well, if they do guaranteed issues, they don't get a lot of leverage. Well, they get more than they have now, right? Worst case, let's say it's a 75-year-old and they got $100,000 sitting somewhere. They can reposition it here. Then that $100,000 is $115,000, right? That's $15,000 more than they had. Plus, they've got the tax benefits now of that, plus the tax-deferred growth of the annuity. I talked to one advisor recently who has a client that's actually in a nursing home, right? And they're they're just paying out of their checking account for their nursing home stay, but they also have a $100,000 annuity. I'm like, well, why aren't they using that? Why not reposition that $100,000 annuity into this product and use that first to pay for their long-term care before they start using their own money setting in their checking account? Because somebody in a nursing home could purchase this. It is guaranteed issue. And then alternative to long-term care insurance, I read somewhere, I think it was like 46% of traditional long-term care cases are declined or not offered coverage. Obviously, this is a great pivot product for those situations, right? If a client needs long-term care insurance, which they would if they're applying for traditional long-term care, they can't qualify, can pivot to a product like this, and they will qualify. And then, like many things, it's a great opportunity in annual reviews just to ask those simple questions of the client. What are their plans if they do need assisted living down the road, or home health care, or nursing home? And if they don't know what their plans are, or if their plans are not tax efficient plans, then it's a great time to have that conversation with them. Okay, so just to wrap up, kind of why bridge? We touched on all this stuff, but lots of accumulation growth as a fixed index annuity chassis, flexible premiums, right? That's a big advantage. Talk a lot about the underwriting and the guaranteed approval within that, the flexibility of the long-term care benefit, giving the client some power in how they want to design it. Indemnity, right? A much easier claims process than going through the reimbursement process. The fact that our charges are typically going to be a lot less than the competition because of the way we've structured that based on net amount of risk. And then of course, the wellness program, which is going to give the client just an additional benefit and something additional that's going to give them additional coverage, but more importantly, going to help them age in place and hopefully avoid that nursing home altogether. Last thing I want to mention before I turn it back over to Katie is licensing and training. As I mentioned, this is a new product, so before solicitation, you would need to go into our website and do the Equitrust product training for the bridge product. So please make sure you do that. And then the long-term care rider is a true long-term care rider. So depending on your state, you may need additional licenses, right? Maybe you only have a life license, but your state requires a life and health to sell long-term care. We do have a chart on our website, and I'm sure Katie could also get that to you. There's a state-by-state breakdown of what's required in each state for licenses to sell long-term care insurance, and also what's required from a CE perspective. Okay, so check, like I said, you can grab that right off our website, or you can reach out to us so we can help you with that. That is all I have today. I really appreciate your time and your interest in Bridge. I am going to pass back up to Katie and see if there's anything she'd like to add or any questions I can answer.
Well, thank you so much, Jason. I really appreciate that. That was fantastic. A couple questions, and one is regarding marketing materials. Are there social media opportunities with your marketing materials?
Not at this point, no. We do not have anything regarding social media on any of our marketing materials or any of our products right now.
Perfect. Nope, that's fair. Another question is regarding the underwriting process. Can you review the underwriting process again? So what goes on once that's what I think they're asking is what goes on once the app goes in?
Yep, so, and I should have mentioned this, but as far as the underwriting process, once you do the application, you can do the underwriting right then, right? Point of sale underwriting, or you can schedule it for a later time. Now, it's all done through the Equitrust MICROSITE that we talked about a little bit ago. So they would go in there and they would either initiate the interview right then or schedule it for a later time, or opt out of the underwriting. Like I said, they can skip it completely if they just want to take the guaranteed issue. Now, once they do it, the only thing involved in it is there's 5 application questions. I will say if they answer yes to any of the first 3 questions, that means they're going to be guaranteed issue. So basically, if you answer yes to the first 3 any of the first 3, you may as well opt out of underwriting and not even do it because you're going to get the secure class for that. And I'll tell you, those questions they're along these lines. Are you currently in a nursing home facility or assisted living facility is number 1. Number 2, do you currently need help with your activities of daily living? And then number 3 is, do you need assistance with a wheelchair or a walker? If you answer yes to those, you're going to be guaranteed issue. If you answer no, then I would proceed with underwriting because there's a good chance you're going to get standard or preferred. Then the only other thing involved beside that is that video assessment. right, that you would do with an underwriter via video, which lasts 20 to 25 minutes on average. And then you get the decision right then, right after that.
Perfect. Are any of your states pre-appointment?
I don't know which ones right offhand. We have a sheet on that somewhere. I know some states require our pre-appointment. Actually, on our website, I think there's a sheet, but I could find that, Katie, and email it over to you to show you that, and you can forward it to the person.
Perfect. Other than that, I think do you happen to know what those other 2 questions are out of those 5?
Yeah, just a second. I do have that. Yes. Bear with me just a second. I got it written down here somewhere.
Is height, weight considered in this?
Nope. No height, weight chart. Nope. One of the nice things about the video underwriting is that's why we don't need a height, weight chart. We don't need a third party involvement because we do have the video assessment. Let's see. So the other 2 questions are, I don't have the question, but basically question 4 is regarding certain medical conditions in the past 5 years. Okay. So it's going to run through a list of, have you had this in the last 5 years? Maybe it's cancer or something like that. I don't have the full list in front of me, but it's about medical conditions in the last 5 years. And the 5th one is, have you received Social Security disability in the last 5 years? Now, if you answer yes to either of those questions, that does not mean you'll get guaranteed issue. It might mean that you go from preferred to standard, but not to guaranteed.
Great. Another question that's coming in is regarding any states that are excluded from this product. So what I can do is I will go out on your MICROSITE and get the most recent list of approved states, because I do know, what did you say, 23 so far?
23, yeah. I'll say the only state I know we won't be in is New York. We don't do business in New York. So every other state we're working on approvals in currently. So, but we're at 23 right now.
Is there a minimum amount of money that a client could add annually?
Yeah, well, I mean, it's $50,000 to start it. Then for additional premiums, I think we require $2,000. If they add money to it, it has to be at least $2,000. We do have some flexibility on that, by exception if it's less than that. Like maybe they're going to send in $500 a month or something like that, then that's probably something we would do. I would say if it's less than $2,000 additional premium, just to check with us.
Perfect. Well, Jason, I think we've answered most of the questions for now. If there are any additional, please, as always, feel free to give me a call here at the office. I am at extension 226 for some of you that we haven't had the opportunity to work together. I look forward to hearing more and more about this product, and I will be sending out a follow-up with some of these pieces that we've discussed, and also a pre-qualification for any long-term cares ideas that you may need. So with that, Jason, thank you very, very much again. I really appreciate it. And to everyone else, have a great afternoon.
Thank you, everybody.
Take care. Thanks, guys. Goodbye.